So we're all here tonight for long-term care insurance, a virtual program, uh, a very timely one, and something that I think we'll all learn from, because you may think you've thought of everything that you needed for retirement. You may have your 401k, your retirement nest egg, a diversified portfolio, but do you know how to protect your retirement investments should you need long-term care? So we're going to learn more about that in a few minutes from Aldo Pantano. He's with the Connecticut Partnership for Long-Term Care with the State Office of Policy and Management. And he's going to tell us how to protect our savings, our life savings with long-term care insurance. And just so that everyone knows, there are no sales pitches here. There's no solicitations. There's no company specific products being discussed. This is just straight information. The Connecticut Partnership for Long-Term Care policies are affordable. They provide asset protection, and they also offer peace of mind through the retirement years. And we're going to learn more about how this program works through Aldo Pantano. Again, he is from the Connecticut Partnership for Long-Term Care with the Connecticut State Office of Policy and Management. He's a frequent speaker on this subject. Very frequent, as a matter of fact. He was telling me about the dozens and dozens of programs that he's been doing. So you're all in very good company. There's lots of people that are interested in learning about this. Aldo is also responsible for training insurance agents through the Connecticut Partnership for Long-Term Care Producer Certification Training Program. And in addition, he works closely with consumers and insurance agents to answer questions about the Connecticut Partnership for Long-Term Care, Medicaid, Medicare, and long-term care insurance. Aldo has been with Connecticut Partnership for Long-Term Care for 13 years. And prior to joining the state, he spent 24 years in the private insurance industry. In his last 6 years with the private sector, Aldo also served as a sales executive promoting and selling group long-term care insurance to employers with 500 or more employees throughout the country. He was doing that. He holds a BA degree in marketing from the University of Hartford. And now, without further ado, let's welcome Aldo Pantano and get started on our learning. Welcome, Aldo.
Well, thank you very much. Can you hear me okay?
I can hear you just fine.
All right, let me see if we can get started here. And again, thanks everyone for joining us, and a big thanks to Holly for organizing and sponsoring this event with the library. We really appreciate it. Unfortunately, we have a big problem paying for long-term care in Connecticut and in the rest of the country as well. And that's because of different reasons, including many misconceptions and misunderstandings, with the first misconception being around what long-term care is and what long-term care is not. Long-term care is not healthcare. Somebody falls down, ends up in the hospital. You have doctors, nurses providing skilled care, high-tech, MRIs, CAT scans. The primary purpose is to fix what's broken and send us home as quickly as possible. With long-term care, we are referring to everyday situations such as bathing, dressing, eating, going to the bathroom, everything we do throughout the day. Or we may also need long-term care because of a cognitive impairment such as Alzheimer's. So we need guidance or supervision in order to avoid endangering ourselves and or others. The majority of long-term care is provided at home. That's where people rather be. And then you also have settings such as adult daycare center, assisted living, and the two words none of us want to hear, nursing homes. And about 75-80% of the people who need long-term care receive long-term care outside of nursing homes. So nursing homes have their purpose, but they are more in the minority rather than the majority of settings where long-term care is provided. Long-term care is also known as custodial care, and you don't need a doctor or a nurse present if somebody needs long-term care throughout the day. Another misconception is the risk of needing long-term care. Most of us tend to think, I don't have to worry about it. That's for the older years. It's not going to happen to me. But unfortunately, reality is that close to 40% of people need long-term care they're under the age of 65. And that's because of many sports injuries, accidents, long-lasting disease or disability. You have Parkinson's, you have MS that may attack someone at a young age. Uh, Alzheimer's is no longer just for an older person. A friend of mine's sister at age 49, an attorney, she was diagnosed with Alzheimer's, and 5 years later, she passed away in a nursing home. Another friend of mine right now, his spouse has been diagnosed with Alzheimer's. So they're trying a lot of different new treatments to try to delay the onset. And she's in her mid 50s right now. And lastly, another friend, his mother had Alzheimer's for 20 years. On one side, they have 4 daughters, 2 sons, and the husband. They all took care of her, and she was able to stay at home as far as they knew comfortably until they had to hire somebody to help out. But for some reason, Alzheimer's seems to prefer women, and experts may not completely agree on this, but in general, the longer we live, the greater the chance of needing some type of long-term care. So with women living longer later on in life, perhaps there are more females that unfortunately experience Alzheimer's. Another misconception is the cost of long-term care. Many of us have no idea what this really means. The Northeast, the cost of living is high, so the cost of care is high. Connecticut is the second most expensive state in the country when it comes to long-term care expenses. The most expensive state, if we want to guess it, I'll give you a hint. It's one where if you're looking out of the balcony of your nursing home, you will see on a clear day Russia sitting over there someplace, and you are in Alaska. $950 a day or $350,000 a year. That's how much long-term care costs in Alaska. So don't get sick and need long-term care when you're over there. For the most part, it's very difficult to get services. Fortunate for us, we are not at the same level as Alaska. No state comes even close. But the reality is that the expense of long-term care can impoverish somebody fairly quickly or spend down our income and assets quick enough to the point where we're considered poor if we're not prepared for this type of expense. The average daily benefit, and we conduct surveys at the end of each year. We've been doing it since 1988. The average in Connecticut is $456. That means that many nursing homes charge much more and some charge less. That's close to $166,000 a year. Now, think about it for a moment. What would the average family do, even if they're paying for home care services, whether it's $80,000, $60,000, $100,000 a year? These kinds of expenses can set a family in a poor level fairly quickly. So if we can do some things to avoid this risk, to reduce it or eliminate it altogether, it's definitely worth it for us to consider it. We all work hard to put together our 401k, our retirement, our investments, owning your home. However, there's no other insurance that protects us for these types of expenses unless we take steps to prepare ourselves and avoid investing our income and assets. Notice here that the average annual inflation since '88 is at 4.8%. The good news is that over the last 8 years, the cost of care for nursing homes has increased much closer to under 2%. The average over the last 5 years is about 2.4%. And the difference between last year and this year is an increase of 2.5%. So slowly, You never know what tomorrow will bring 5-10 years from now, but the trend has been for the nursing homes expenses not to increase as rapidly. Definitely something to think about. And inflation protection with long-term care policies is very important, and I'll say more about that as we go along. If long-term care is so expensive, who's been paying for it? Well, you have here the 22% or so that are paying for it out of their pocket, income, assets, whichever way they can get by, and eventually may become poor. Then you have more than 10 million people in the country that have purchased long-term care policies. And in Connecticut, we have policyholders who have purchased both non-partnership policies and partnership policies. More than 60,000 people have purchased this special policy that falls under the Connecticut Partnership for Long-Term Care. We see here that Medicaid is the largest payer for long-term care, 61%. As a single person in Connecticut, to qualify for the Medicaid nursing home program, since there's home care, there's other options. As a single person, we have to spend down our assets to $1,600. When our assets are down to $600, then we are considered poor and we can qualify for Medicaid. For a married couple, the state doesn't want the community spouse living at home to become poor because the other spouse needs long-term care through Medicaid. So the community spouse gets to protect the house and the car regardless of value. And there's a formula in place that states that the community spouse can also protect up to 50% of their other assets, but no more than $130,380. So in an ideal situation, the community spouse protects house, car, $130,380, and then everything else must be spent down to the $1,600. Now, we're talking about assets. For a single person, he or she is down to $1,600, and then their income is reduced to $60 a month. For the single person, he or she will be able to keep $60 a month. The rest will be used to help pay for care, or 60 plus 90 if you are a wartime veteran. Now, for the community spouse, when you have a couple, the community spouse at home, if the spouse is making substantial income, then there's a formula in place where a portion of the spouse's income is used to help pay for the institutionalized spouse. The opposite is also true. If the community spouse living at home, let's say he or she needs $7,000 a month to live comfortably as they have before the need of long-term care came, then if she doesn't have enough income for those expenses, the income that is being used and taken away from the spouse in the institution can be diverted to go towards the community spouse so that he or she can take care of expenses and hopefully live comfortably. Please note here that we're not even listing Medicare, which is another misconception. People think Medicare will pay for everything. Medicare is not designed to pay for long-term care. If you need 7 days a week, 24 hours a day, Medicare will not pay for it. If you need guidance or supervision because of a cognitive impairment, Medicare will not pay for it. When will Medicare pay for it? It's very specific situations. Somebody has an accident, damages a hip, ends up in the hospital. You must be hospitalized at least 3 days without counting the day of discharge. And then you need some rehabilitation. So in those instances, Medicare will pay for it. On average, Medicare pays about 25 days. Day 1 through 20 is paid in full. Day 21 through 100, you pay $185 out of pocket every day. After 100 days, Medicare won't pay for anything else anymore in the nursing home. And the average length of stays in Connecticut and in the rest of the country for nursing homes is 2.4 years. Therefore, as you can see, 100 days doesn't pay for much. And even further, the average long-term care Medicare pays for in a nursing home is 25 days. So definitely Medicare turns down many people who unfortunately eventually may end up qualifying for Medicaid. So why is the state talking about long-term care and long-term care insurance and the Connecticut Partnership for Long-Term Care? We can choose to ignore these topics, but in the end, it's always going to be there. Each day as we get older, you never know what's around the corner, and eventually, if we reach age 65, we're fortunate to do so, close to a little over 50% for women who will need some type of long-term care, and about 47% for men. The cost is also very high. I mentioned the Northeast, Hawaii and Alaska are also very expensive. And you have many other states, I estimate 75%, Mississippi, Louisiana, Florida, Arizona, South Carolina, many states charge a lot less because the cost of living there is less as well. And let's point out they don't get as many services as they get in the states where the cost of living is higher. The Affordable Care Act, Medicare, group insurance, health insurance do not really pay for long-term care. With Medicaid, you have to become poor, and none of us want to do that. And another reason to discuss long-term care is because of this special program called the Connecticut Partnership for Long-Term Care. Back in 1990 or so, the state of Connecticut was very innovative and proactive, introducing the first partnership program in the country. Today, we're glad to see that there are 45 states with partnership programs. And instead of telling you the 45 that have it, let's go the easy way and focus on the 5 that don't have it. Hawaii and Alaska don't have it. Mississippi, Vermont, and Massachusetts don't have it. Massachusetts and Vermont have talked about it. We have had telephone conversations with Massachusetts, but they have not pulled the trigger at this point, and we don't know if and when they will. The partnership was established with 4 goals, which are still true today. First, to help us Connecticut residents to have more peace of mind and be better prepared to protect our assets should we have a long-lasting disease or disability that requires long-term care. What the partnership does is, in addition to insurance, it also gives us a huge safety net, which will further help us protect our assets. I'll give you many examples so that you understand how that works. If the state was going to enter into a partnership with insurance companies, then we wanted to make sure that much higher standards would have to be met with partnership policies than non-partnership policies. One example is that since 1992, the partnership has required all partnership policies to include 5% compounded automatic inflation protection, which is a very strong feature of partnership policies, because after 14 years, if you have not filed a claim, the insurance benefits you have purchased double in value. So each year they go up by 5% compounded, and then eventually they double. And so you have a lot more insurance and also asset protection, which I'm going to clarify shortly. To educate the public as much as possible, before the unfortunate times that we're in, we were meeting with about 1,000 people throughout the state maybe 50 presentations, but we are fortunate enough to be able to talk to you in presentations such as tonight. And the purpose is to help you understand as much as possible the critical issues about long-term care, the problems, and the possible solutions that the Partnership for Long-Term Care presents that no other program in the country can offer. The last goal is for the partnership to help the state Medicaid program conserve state Medicaid funds. Let's see if I find the number here. There's a formula in place. It's been in place since 1992. The partnership program has saved the state Medicaid program more than $64.9 million. And that's because the more and more people purchase long-term care insurance or the Connecticut Partnership for Long-Term Care, then you have less people that run out of insurance, that become poor and have to end up applying for Medicaid. This is where the partnership takes off in a whole different direction than non-partnership policies. I mentioned that we can buy a Connecticut Partnership for Long-Term Care policy just like we buy any other insurance policy, homeowners, life, disability. We meet with an insurance agent. The agent must be certified to sell partnership policies, otherwise they cannot talk about it. And we submit the paperwork, an underwriting form in general. If we are approved for coverage, then we pay premium to the insurance company. We hope we will never need long-term care, but if someday we do, we file a claim with the insurance company, and if the claim is approved, they begin to pay insurance benefits. And here's where the partnership is different. In addition to the insurance benefits, we also have an account called the Medicaid Asset Protection Account. When we buy a policy, regardless of the lifetime maximum that we select, because it varies, and we choose what that lifetime maximum can be. Obviously, the higher the lifetime maximum, the more expensive the premium will be. But we get a Medicaid asset protection that is equal to zero. It will continue to stay at the same level until we file a claim and the insurance company approves and begins to pay insurance benefits on your behalf. Every $1 of insurance paid by the partnership policy gives you $1 of Medicaid asset protection. So if after a month, $10,000 has been paid by the policy, that gives you $10,000 of Medicaid asset protection. After 5 months, $50,000 paid, that gives you $50,000 of Medicaid asset protection. You get the picture. After 1 year, let's say $120,000 is paid by your policy. Now you have this value of $120,000. Now it's not a bank account where you can withdraw money or deposit. It is a value that stays with your name, with your account. And it comes in very handy at the time when we apply to Medicaid for running out of insurance benefits. Let me give you 2 quick examples. These 2 ladies, 68 years old, purchased partnership. One has purchased a non-partnership policy. One has purchased a partnership policy. The pool is $300,000 for each. Same age, same health, same everything. The first individual with no partnership policy files a claim 10 years later. She runs out of insurance and now still needs care. So she has to apply to Medicaid and must first spend down assets to $1,600 as a single person. The second individual is a partnership policy that will pay out $300,000. So after $300,000 is paid, she has $300,000 of Medicaid asset protection. Now she applies to Medicaid. Medicaid says, you have earned the right to protect $300,000 because that's how much your partnership policy paid out. In that example, she keeps $1,600 plus $300,000. So you have two Connecticut residents. They both had good intentions by buying long-term care insurance, but one didn't know anything about the partnership and purchased a non-partnership policy, which gave her no Medicaid asset protection. She ended up on Medicaid with $1,600. The second individual ended up on Medicaid with the $1,600 plus $300,000, which is what the partnership policy had paid out. Therefore, the Department of Social Services, which handles Medicaid applications, when determining eligibility, it will disregard any assets that you have up to the amount the partnership policy has paid in benefits. Once you have earned the protected amount of assets, you can do whatever you want with it. Give it all away, keep it, spend a little bit at a time, buy pizza, wine, and beer every Friday night in the nursing home for everybody. Everybody will love you. But again, it is your choice, and you can transfer these assets immediately after you qualify for Medicaid. And you can also transfer them even before you qualify for Medicaid. But let me give you some examples first, and maybe I can say a little bit more about that. We have 4 people here: Alice, Bob, Cindy, and Dave. Took us a week to come up with the names, and give everybody a chance to make suggestions. And then we have the assets for each person and the partnership, insurance benefits paid out or not, as in David's example. The 4th column is countable assets. That's how Medicaid will see the situation for the individual. Alice is based on a real example. Grandmother at $100,000. She did not want to do anything creative that is legal to hide or protect or transfer her assets. She met with an insurance agent certified to sell partnership policies. The agent explained to Alice, if you wish to protect $100,000, you must first buy a partnership policy that pays $100,000. And that's what she did. Unfortunately, 2 years later, she developed Alzheimer's, files a claim with the insurance company, they approve, they begin to pay benefits. $50,000 paid, she has $50,000 on Medicaid asset protection. After a year and a half, let's say $100,000 was paid, she has $100,000 on Medicaid asset protection. At that point, she applies to Medicaid. Medicaid says at first, Alice, you're single. You have assets of $100,000. You got to spend it down to $1,600. But Alice submits to Medicaid the special report called the Quarterly Medicaid Asset Protection Report. By state law. It is required for the insurance companies to send this report every 3 months. And we also get a copy at the Office of Policy Management where I work. Make sure that those are being sent out. And that report, the primary purpose is to tell you how much insurance has been paid, which also tells you how much Medicaid asset protection you have. And it's also a great tool to alert somebody that if you have a $100,000 policy and your policy is paid out $50,000, $60,000, now you know you don't have that much more left with the policy. So it's time to try to make some plans for the next stage. So Alice gets $100,000 protected. She immediately transfers it to her daughter to help pay for the grandchildren's education and other expenses. And then she went on for 4 more years needing long-term care, and Medicaid pay for it. So this is an example of where somebody in some circles does not have a lot of assets, but she was able to achieve the equivalent of unlimited coverage because her care was first taken care of when insurance paid for her expenses, so she did not have to pay out of pocket. And then when she ran out of insurance because of the partnership and Medicaid asset protection, she was able to protect $100,000 and do whatever she wanted. Now, Bob here is the same example, except he has $200,000. He buys a policy that pays $200,000. Once it runs out of insurance, applies to Medicaid. Medicaid says, Bob, you have 200,000. The Medicaid asset protection report shows that you have earned the right to protect 200,000. So from the financial perspective here on countable assets, Medicaid concludes that Bob has 0 countable assets, even though in reality owns $200,000. So again, Bob can give it all away. He can keep it, doesn't have to do anything with it. He can spend as he wishes. If Bob keeps 200,000 under his name, a year later at renewal, if 200,000 has grown to 220,000, the extra 20,000 must be spent towards care. If Bob, let's say, is married, because all these people are single here. If he's married and he transfers 200,000 to his spouse at renewal, Medicaid says that the 200,000 are no longer under his name. It does not matter that they are under the spouse's name or anybody else's, because once those assets are no longer there under his name, then Medicaid will not ask what happened to them. Those are protected assets. He can do whatever he wants. Cindy is an example of the equity of the program. She has $1 million, met with an insurance agent. The agent says, Cindy, to earn 1 million of Medicaid asset protection, first you have to buy a partnership policy that includes a pool of money of 1 million. Cindy decides that she doesn't want to spend that much, and she buys a $200,000 policy, partnership policy. 10 years later, she files a claim. The insurance company begins to pay. Eventually, they pay 200,000, so she has 200,000 of Medicaid asset protection. She still needs care once she runs out of insurance, applies to Medicaid. Medicaid says, Cindy, you have 1 million. You have earned the right to protect 200,000. The difference of 800,000 is what you have to spend down in order to qualify for Medicaid. Another way that Cindy could have achieved 1 million of protection would have been by buying a $500,000 policy with 5% compounded on the automatic inflation protection. And each year, 500,000 would have gone up by 5% until, if she filed no claim for 14 years, then $500,000 would have grown to 1 million. And if at some point she developed Alzheimer's or some situation that lasted a long time and her policy paid 1 million, then she would have achieved 1 million of Medicaid asset protection. David here is an example of someone who says, hey, whatever happens, happens. And some of us do that. Or, unfortunately for Dave, he met with an agent who was not certified to sell partnership policies, and he could only sell non-partnership, and that's what he did. He sold them a policy worth $200,000. David runs out of insurance from the non-partnership policy. There is no Medicaid asset protection, still needs care, applies to Medicaid. Medicaid says, David, you are single, you have 0 Medicaid asset protection. You have to spend down your assets to $1,600. And notice that I have not used, I have not applied inflation amounts here, otherwise it would get a lot more confusing. And we'll take questions on these issues later, if there are any. One thing to point out is that the insurance company has nothing to do with Medicaid asset protection except some administrative responsibilities, such as the Medicaid asset protection report and information to send to us at OPM. Medicaid asset protection is something the state is doing for all of us. We're taking responsibility to protect ourselves against the need of long-term care expenses. And Medicaid asset protection is 100% free. Therefore, there's not 1 penny added to the cost of insurance, because again, it's the state doing it. If we compare a partnership and a non-partnership policy from the same insurance company, we will see that as long as we're comparing apples to apples, the premium is identical. Obviously, if you compare a partnership policy for example, with 3% compounded in a non-partnership policy with simple inflation or no inflation, the company or the policy that grows the highest, the largest amounts is where the premium will be higher. One side point here to make: the state of Connecticut is required by the federal government to recover the funds paid for an individual's long-term care in the nursing home through Medicaid. As noted here, assets protected through the partnership will not be recovered by Medicaid. So if those assets were protected by the partnership, the state will not go after to recover those funds. All right, so one of the questions that often comes up is, what happens if I move out of Connecticut? I mean, let's face it, we're seeing it right now. Many people move in, out, it's normal. If you move out of Connecticut, your address changes. Your partnership policy is a contract between you and the insurance company. You take it with you anywhere you are in the country. If at some point you need long-term care, unfortunately, you file a claim with the insurance company. If they approve and begin paying benefits, then you start to build up your Medicaid asset protection. So anywhere in the country, does not matter where your address is for filing a claim. And some insurance companies also include Canada as part of their territory. So if that's important for you, ask your agent if you meet with them to get a quote or more information. So your address is very important in 2 points. First, when you apply to buy a Connecticut partnership policy, you must provide a bona fide Connecticut address. It cannot be a work address. It cannot be a P.O. box, since we don't know anybody that lives there yet. So bona fide Connecticut address, and then it does not matter if 3 weeks later you move. It does not matter if you live 10 months in New Mexico and 2 months here. It does not matter if you don't pay taxes here or if you vote here. Bottom line is, provide a bona fide Connecticut address, and then there's no tracking after that. The other point in time when it's very important where you live is the following. We are talking about reciprocity. As of January 1st, 2009, 44 states have been part of the reciprocity compact set up by the federal government. No state has opted out since January 1st, 2009. There is one state that from the beginning chose not to be part of the reciprocity compact. They thought that we were all going to go move over there, which is not realistic. Mudslides, wildfires, earthquakes. I mean, it is a beautiful, beautiful state, but in the end, we live where our roots are, where our families are, where we work, where our friends, wherever we are comfortable. California chose not to participate in the reciprocity agreement, and they're just hurting their state residents. If I lived in California and I bought a partnership policy and I lived there for 25 years, and then finally I decide I want to move where my son and daughters live in New Jersey or Florida or Connecticut. If at some point I need long-term care, the insurance policy will pay benefits. But when I run out of insurance, if I want to take advantage of Medicaid asset protection, I would have to move back to California. And that's not a pleasant situation if you had decided to live the rest of your days somewhere else. So how does reciprocity work? Let's say I buy a policy in Connecticut. I move to Florida. And 10 years later, I have run out of insurance benefits. I have Medicaid asset protection. I file a claim with the Florida Medicaid program. As long as Florida then and Connecticut have reciprocity with each other, then the state of Florida Medicaid will recognize the Medicaid asset protection I earned. Now, if I am in the Medicaid program and for some reason Florida and Connecticut decide to opt out, I would be grandfathered in because I'm already in the Medicaid program at that point. However, if I'm in Florida and I run out of insurance, and if at that time, for some reason, Florida and Connecticut don't have reciprocity, then my choice would be to either stay in Florida and pay for extra care out of my pocket, or move to any state that has reciprocity with Connecticut, or return to Connecticut to take advantage of the Medicaid asset protection. And the reason I tell you this is because I want you to be aware that states can opt out of the compact by giving the federal government 60 days notice. Again, since January 1st, 2009, no state has opted out. What the future holds is hard to say, but keep in mind that the most important time with reciprocity is the time when you run out of insurance and wherever you live. And the question is, does that state with Connecticut have reciprocity with each other at that time? Now, there are 3 insurance companies today that are selling partnership policies. And since 1992, we've had 25. Started out with 3: Travelers, Amex, Blue Cross Blue Shield. Notice they're not here. And sometimes we've had 3, 5, 6, 8 insurance companies have come and gone. Just because an insurance company stops selling new policies, they're still 100% responsible for administering, servicing, and paying claims, and for maintaining reserves and everything that is required in Connecticut as when they were first doing new business here. So the 3 companies are Bankers Life, Casualty, Genworth, Transamerica. We have seen a number of situations where insurance companies may have decided not to sell new policies, and they sold their book of business to a healthy insurance company that the state of Connecticut had to approve. I would like you to make a note that if you are interested, again, this is all up to you, but if you would like to see some numbers, some quotes, insurance options, it's good to check with different companies so you can compare. Transamerica Life here has announced that as of July 1st, 2021, they will not be selling more long-term care and partnership policies. It's a decision, obviously, the corporation makes. How things will change in the future, we don't know, but we suggest if someone is interested in getting quotes from any of these insurance companies to take advantage of getting one from Transamerica as well, so you can compare. And Genworth, they sell policies through an internal sales staff. So we have to call Genworth and ask to speak with someone who is certified to sell partnership policies, and they can help us on the phone and then mail whatever information we need. You see here the 800 number. If you have questions, I'm going to give you another phone number to call for questions where you may get quicker service because more of us are in the office, and somebody will get back to you with the 800 number. It may take an extra day, I don't know. They're working all remotely. The number I'm going to give you is for the partnership hotline, 860-418-6318. Again, 860-418-6318. If you have any questions at all, we help people all the time, 85, 90. I had somebody was like, I think 94, 75, 45. People call, they have questions, they need help. So we're there to help out with their best interest in mind. You can also go on our partnership website. Under consumer, link for consumer, you can download a wealth of publications, frequently asked questions, important topics related to the partnership and long-term care, government programs, how Medicare, Medicaid work. So it's a good website to visit when you have time. As a side note, in addition to tonight's presentation that is being recorded. You will also notice on our website, there are two videos. One is very similar to tonight's presentation, and one is frequently asked questions, which hits a lot of points that we discussed, but from different angles and additional information as well. All right, so having said that, I hope we have some questions, and I'll open up the floor to get Holly to help us out.
Thank you very much, Aldo. You really, that was a lot of information, and first time I've heard about it. So I'm sure that a lot of the folks in the audience are digesting, but it looks like we do have some questions coming in from chat. So first up, let's see here. Does the state actively pursue companies to participate in the program?
Okay, the answer is no. The state does not pursue companies to actively participate. They come to us because they have to submit some paperwork to meet the requirements of the partnership. And the industry in general is in a point of there will be changes. What doesn't change is the need of long-term care. What has to change is to give us more incentives to consider buying the insurance, such as tax deductions, tax credits, which 26 states do. Connecticut has talked about it for 15 years, but unfortunately, that bill on tax credits gets attached to another bill, and the other bill is turned down, and tax credits don't make it. But what we're hoping to see someday is a solution at the federal level in order to make it a lot more broader in terms of interest and for more insurance companies and for people to be interested.
Thank you. That was interesting. Okay. Let's see. Good answer. Good question. And now we have another one. Is it a requirement to access Connecticut Partnership through a certified agent, or can you access the partnership directly? And there's a follow-up question to that too.
In order to purchase a Connecticut Partnership policy, you can go about it a couple of different ways. One is contact Bankers Life or Transamerica and ask to speak with a certified agent who can talk about the partnership. With Genworth Financial, as I mentioned earlier, you can call Genworth directly and ask to speak to someone who is in their sales area, and they can provide a quote. So you got to go through somebody. There's not a website someplace where you can just submit information and get a quote.
Okay, thank you. And then another question, do you know why all the other long-term care insurance companies from many years ago exited the long-term care insurance business?
My manager likes to say we would have to ask the chairman of each company to figure out exactly why they chose to do what they did. But one personal comment here from me is that if the insurance companies were making a tremendous amount of money, they would all be fighting each other to step in and sell these products. It is a long tail. You may be paying for 20, 30 years. You hope you will never need it. So the question is, do I want to invest each year, whether it's $1,500, $3,000 a year? It varies by age and how much insurance you purchase, male or female, your health, in order to protect 300, 400,000, $500,000 at some point in the future. So that's something we, as an individual, need to look and see what works for us. So insurance companies, if we start seeing more incentives for people to consider long-term care insurance, then we think we're going to see a lot more insurance companies jump in, because you need large numbers, and that's always going back and forth on whether that really worked. A lot of times people buy because they know they have some condition in the family, and they say, "Oh, I better protect myself." Or others may say, "I will never need this. I don't have to worry about it." At 63, 65, he has a stroke, and next thing you know is he becomes uninsurable. And so that's the risk that you take by waiting too long to purchase a policy.
Okay, thank you for that.
You're welcome.
We do have another question that's come in with regard to the assets. When you're required to pay down your assets to 1,600, the individual assets of 1,600, what assets are actually included in that total? So is this artwork, coin collections, furniture, TV, stereo, etc.?
So Medicaid is very complicated, and that's why elder law attorneys provide a great service to help people out who are thinking about assets, protection, and so on. When you apply to Medicaid is concerned initially primarily with two columns. One is assets and one is income. Everything that you can cash out, such as bank accounts, checking account, IRA, a pension, if it can be cashed out, stock investments. If you have insurance policies with cash value and the face value of the policy is 1,500 or more, that can be cashed out and you will be required to cash it out. So that's how your husband or your wife's 401k plan, it does not matter whose name it's under. When you apply to Medicaid, everything is considered jointly held. Now, if you have items of extreme value in the house, they will be considered as assets, but in general, furniture, television, refrigerator, all those things are not considered as part of the assets.
Okay.
The other column is income, which is Social Security. Normally, you can't cash it out. And then you'll also have situations where there are pensions that cannot be cashed out. Therefore, in that instance, the pension is considered income and is added on the income column. So you have assets and income. Anything that you can liquidate normally falls under the assets.
Okay. Thank you. I hope that answered the question. If not, please get back to us via chat. There's another question that's come in regarding the insurance companies themselves that are handling the long-term care insurance. What happens if one of those insurance companies becomes insolvent? Are the policies guaranteed by a Connecticut insurance guarantee fund or some kind of other market?
All right, so there are 400 companies that sell healthcare products in Connecticut. In order to sell healthcare products, they have to agree to be part of the Guarantee Health Fund, which applies to health products, and long-term care is under health. And there's also property and casualty separately. And if an insurance company goes bankrupt, each one of us who have partnership policies or non-partnership policies, through the Guarantee Fund, we are guaranteed up to $500,000 of insurance to be paid for our policy if we have that much. If our policy pays $300,000, that is all we're going to get. If the policy pays $700,000, we're only going to get $500,000. So the cap is at $500,000 today. Whether that will change in the future, we'll see. But that's one of the safety nets in place to protect the consumer should one of the insurance companies go bankrupt.
Okay, thank you.
Well,
So that's good to know. Now, maybe you discussed this earlier on, and I hope this doesn't sound like a silly question, but because I know this is not a traditional kind of insurance product, but what happens what happens if the insured dies? And you've paid in for all these years for all this protection, and then wham, you're gone. And that it's just everything's what happens?
So a couple of different things can happen. Um, some of us have paid homeowners insurance for 40 years. Then we die and go to heaven. And, we had
That's
insurance and peace of mind all that time. When the tree landed on my house 12 years ago, I think that's when it was, $16,000 of damage in 3 seconds, and we're lucky we didn't get killed. I walked outside and looked at all the damage, and my neighbors were having a party, taking pictures on top of the tree and all that good stuff. You know what? It was terrible, but I knew I had insurance. And that makes all the difference in the world. Very quickly, they gave us a very nice check and pay for all the damages. The insurance worked that time. With long-term care insurance, like automobile insurance, homeowners is the same thing. If you never use it, in general, you don't get anything back. You
right.
may have, look at situations where you pay $20,000 and a year later you file a claim. Now the insurance company pays $300,000 for you when you have paid $20,000. It is insurance. We hope it never happens. Some people, a small number, have purchased what's called a rider return of premium. And the way that works is that once the individual dies without filing a claim, 100% of the premium paid is returned to a beneficiary. But because the premium in that instance is significantly higher, our recommendation is to take that money. It's not worth it to have a death benefit with your long-term care insurance and buy life insurance if there's something critical for you to achieve.
Okay, thank you. That's a good answer. Does anybody else have any other questions tonight for Aldo while we still have him here for a few more minutes? You're welcome to unmute and ask them live. If it's, too time consuming to type them into the chat, we're happy to do that. I've got one more coming in here. Okay, so the question is, at what age is it really not financially feasible for someone to purchase long-term care insurance? When does it really become it's too late?
So I was doing a presentation at the Killingworth Library, and this lady came up to me, I would say mid-50s, and she was kind of smiling. So when they smile, that's a good thing. And she said, my father at 78 went out and purchased a partnership policy. He didn't tell anybody anything. And he was paying a fortune. The premium was very high because the risk is very high. And these days, they're more restrictive. You may not be able to get a policy at 78, although some of them underwrite until 85. But good luck with that one. So the reason she was smiling was because she said a few years later, he developed Alzheimer's. He filed a claim. And he said, or she said, if you compare what he paid in a few years, which we thought was astronomical each year, and what the insurance company has been paying for him over the years, there is no comparison at all. He made an incredible move by buying long-term care insurance, even though very late in the cycle. It turned out well from the perspective that the insurance company may end up paying $120,000 and he had paid maybe $20,000 in premium, and he kept on paying for his care. So the best thing to do is to buy yesterday, okay? Buy a policy yesterday because we're younger, we have less conditions, greater chance of being insurable, and you have much greater growth with the compounding of inflation protection. I didn't get to mention it before. The lowest inflation protection you can buy with partnership policies, which was changed 5 years ago, is 3%. So all partnership policies require at least 3% compounded automatic inflation protection. And for somebody to say, I'm going to wait 5, 10, 15 more years, Once you become uninsurable, it does not matter how much money you can put out, you will not be able to buy the policy, and then you're on your own.
Okay. Okay, thank you. That was a good answer too. Very thorough. I appreciate
Thank
that.
you.
You're welcome. Well, let's see. Oh, there's just a few more comments. We've got some thank yous from some of our attendees letting me know that they were very appreciative of all the information
Thank you.
tonight. I want to make sure that everyone that's here knows again that Aldo gave that great number, that 1-800-418-6318, 1-800-418-6318. And of course, the website is ctpartnership.org. So ctpartnership.org.
Sorry for interrupting,
No,
Holly.
go ahead.
Just to make sure everybody has it, the partnership hotline number is 860-418-6318.
So it's not 800.
Correct. The other number is 800, where it may take a little longer to get somebody to call you back. The
Oh,
860-418-6318 is the number to get somebody quicker.
Get them faster. Okay, that's good to
Yes.
know. Excellent. We got some inside tips here from the expert. Thank you. Well, if there's no other questions, I want to finish off the evening with a thank you very much, Aldo. You really went above and beyond
Thank
answering
you.
the questions and trying to keep us informed about what the options are here with long-term care insurance in the state of Connecticut. It sounds like not all states have this, so I'm glad you were here with us tonight. For anyone else who's interested in seeing this particular video recording, it will be on the library's YouTube channel, possibly as early as tomorrow, but if not, it'll be there earlier in the week on Monday, probably, what's that, the 8th of February. So again, Aldo, many thanks. You've got some accolades coming in here on the chat feature. People are appreciative, and I wish you all the best and have a safe and healthy rest of your weekend and 2021. All right, everyone. We'll see you soon.
Right, Holly, and everybody, thank you.
You're welcome. Good
Take
night.
care. Bye-bye.
Bye.